It is better to avoid errors than to try to be brilliant. Warren Buffett. Have you ever stopped to think that often the secret to success in investing is not about getting every choice right, but rather about avoiding major mistakes? Buffett, one of the greatest investors of all time, built his fortune not only by choosing good companies, but by steering clear of traps that could destroy his wealth. In this video, we will explore his strategies for avoiding catastrophic investment mistakes. We will understand why impulsive decisions, lack of knowledge, and following the crowd can be an investor's greatest enemies. More importantly, you will discover how to adopt a solid and disciplined mindset to protect your money and ensure sustainable growth. Imagine the peace of mind that comes from investing with confidence, knowing you are shielded from the main pitfalls that ruin investors around the world. Stay with me until the end, because today's lessons could be the turning point in your financial journey. Ready to invest intelligently and safely? Then let's go. Warren has always emphasized that the path to financial success is not about seeking extraordinary returns at any cost, but about avoiding mistakes that could compromise invested capital. For him, preserving money is the first commandment. And as he himself says, rule number 1, never lose money. Rule number 2, never forget rule number 1. This simple yet powerful philosophy guides all his decisions. Let's understand how he puts this into practice and how you can apply these principles to your investments. Buffett avoids investing in businesses he does not fully understand. He calls this the circle of competence. The idea is simple. Focus your investments on sectors and companies whose business model you know well. This significantly reduces the risk of making mistakes. He avoided investing in technology companies during the internet boom in the 2000s because he did not fully understand how those companies generated sustainable value. While many investors lost fortunes in the dot-com bubble, Buffett remained focused on solid and understandable businesses such as Coca-Cola and Gillette. Think about this. If you don't understand how a company makes money, don't invest. Study and learn about the industry before putting your capital at risk. One of the biggest mistakes an investor can make is becoming overly leveraged. That is, using borrowed money to invest. Warren has always emphasized the importance of maintaining a healthy level of debt, both in his personal life and in the companies he invests in. During the financial crisis of 2008, many highly indebted companies collapsed because they couldn't meet their debt obligations. Meanwhile, companies like Berkshire Hathaway, which maintained a solid financial structure, managed to weather the crisis and even seized opportunities to buy assets at low prices. Keep in mind that debt can amplify gains, but it can also multiply losses. Invest with the money you have and avoid unnecessary risks. One of the most common and dangerous mistakes is blindly following the crowd. He warns that most people buy stocks when prices are high and sell when they are low, driven by fear or greed. In the 2008 crisis, while many investors panicked and sold their stocks, he invested billions of dollars in companies like Goldman Sachs and General Electric, taking advantage of low prices. He followed the principle of being greedy when others are fearful and fearful when others are greedy. Never make investment decisions based on what everyone else is doing. Stay calm and evaluate opportunities rationally. Warren has always been wary of investments that promise quick and high returns. He knows that these investments are usually associated with high risks and a significant probability of loss. He avoided cryptocurrencies and speculative startups precisely because many of them lack solid fundamentals. While some people became rich quickly, many others lost everything. He prefers predictable businesses that grow consistently. If something seems too good to be true, it probably is. Focus on solid long-term investments. Warren believes that patience is one of the greatest virtues of an investor. Many make the mistake of expecting quick results and end up jumping from one investment to another, accumulating losses. Berkshire Hathaway held Coca-Cola shares for decades, and that patience resulted in extraordinary returns. He invests with the mindset that he is buying a business for a lifetime. The best results come with time. Be patient and allow your investments to mature. These strategies show that avoiding catastrophic mistakes requires more than intelligence. It demands discipline, patience, and a long-term focus. And as his journey proves, these principles can consistently protect and grow your wealth. Now that we understand the basic principles for avoiding catastrophic mistakes, let's dive deeper into his more advanced strategies. Here, the combination of patience, careful analysis, and the ability to act confidently when opportunities arise comes into play. These elements are essential to avoiding major losses and maximizing the growth potential of your wealth. Buffett has always seen crises as great opportunities, not threats. He understands that the financial market is cyclical and that moments of collective panic create undervalued assets. The key is to stay calm and maintain liquidity to act at the right moment. During the financial crisis of 2008, while the market was in free fall, Warren invested $5 billion in Goldman Sachs, a move that seemed risky but delivered enormous returns when the market recovered. He was able to identify that fear had distorted the bank's real value. When the market is in panic, many solid companies become undervalued. Being prepared to act during these moments can generate extraordinary returns. A fatal mistake in the investment world is confusing price with value. He always teaches that price is what you pay, but value is what you get. He seeks to understand a company's true value before investing, ignoring market fluctuations. His decision to invest in Coca-Cola was not based on price swings, but on the analysis of its intrinsic value. A global brand with recurring consumer products and a strong competitive advantage. Even if the stock price fluctuated in the short term, the company's value remained solid. Before buying a stock, ask yourself, does this company have solid fundamentals and growth potential? The price may fluctuate, but the value endures. Buffett calls this strategy an economic moat. He looks for companies with entry barriers that protect them from competition, ensuring consistent profits over time. Companies like Apple, Coca-Cola, and Gillette are classic examples. Apple has an integrated product ecosystem and a loyal customer base. Coca-Cola has an iconic brand and global distribution. These factors create a barrier that prevents competitors from seriously threatening their market. Prefer to invest in companies with clear competitive advantages, as they are more resilient to crises and market fluctuations. Warren knows that the financial market is driven by emotions. Greed makes people buy overvalued assets, while fear leads them to sell during downturns. He learned to master his emotions to make rational decisions. During the burst of the technology bubble in the 2000s, many investors were euphoric, buying stocks without solid fundamentals. He, on the other hand, stayed away, avoiding major losses when the bubble burst. Develop self-control. Stay true to your strategy and don't let emotions influence your investment decisions. Warren avoids complex or hard-to-understand investments. He believes that keeping things simple is an effective way to avoid mistakes. Buffett has always preferred investing in traditional businesses with predictable cash flows, such as insurance, beverages, and consumer products. He avoids complex derivatives or business models that require complicated assumptions. Don't complicate your investments. Choose companies and strategies that you can fully understand. He is never in a hurry. He understands that building wealth takes time and that sudden strategy changes can be harmful. He believes in the power of compound interest and consistent growth over the years. He held shares of American Express and Coca-Cola for decades, allowing company profits and reinvested dividends to accumulate. Patience in holding these investments generated billion-dollar returns. Don't expect to get rich overnight. Focus on gradual and consistent growth. These strategies show how Warren avoids catastrophic mistakes by combining patience, discipline, and in-depth investment analysis. More than seeking quick gains, he focuses on protecting his capital and ensuring that every decision is based on logic and knowledge. Remember that success in investing doesn't require genius, but it does require discipline, patience, and common sense. Avoiding major mistakes is often more powerful than chasing extraordinary gains. If you adopt this mindset, you'll be on the right path to building a solid and secure financial future. If you enjoyed these lessons and want to learn more about achieving financial success inspired by great investors, don't forget to like this video and subscribe to the channel. That way, you won't miss any content that can transform your perspective on finance and investments. See you in the next video.